Hello, Oracles. Well, Tesla's win streak has come to an end. We did finish red today. Wasn't significantly red, but when the Fed came out and decided to pause rates, that was what we all expected. What we did not expect was the Fed coming out and letting us know that they're anticipating potentially two more rate hikes for the rest of the year. They're looking to get the terminal rate up to 5.6% by the end of the year, which means we could be seeing a 25 basis point hike in July. We'll get into the reasons why I think that is, and another one later on down the road as well. So that kind of put a damper to any excitement we had from a Fed pause. Now, that didn't last very long. After Jerome Powell spoke, we saw the market rally back up a little bit, but we'll get into more of the details on that and where we could potentially see the stock market moving by the end of the year in just a minute. All right, so I was able to get Weeble back up and running, had to reinstall it, got an updated version. So all of my trend lines are gone. I have to go back and figure out where they all were, put all of my trend lines for resistance and support back in, but we can still see the gaps here. I have put the RSI back in. So again, we have a gap here that goes down to 235. It says it right here, gap up. We were on this upward trend, and we have a gap that goes down here to 221.91. And, looking at the trend that we're on, it's looking nice. So close to filling this gap that there's a $262 gap, so close to filling it. So again, we have quad witching going on Friday. We might see a reversal of this downward trend to end the day and push up tomorrow to fill that gap before we end up coming down Friday with the sell-off after quad witching. Just my guess. Again, just a guess. Don't know for sure. But again, we're extremely high in the RSI, more overbought than we have been in the last 2 years. So there's a chance that we're most likely going to be selling off a little bit. However, are we going to fill the gap at 262 first or not? So with the information that the Fed gave us today, kind of let us know that yes, things are moving in the direction that they planned. However, they do anticipate more rate hikes this year. Now, as we saw, they went up very quickly in rates. They went up 5% in the last year. That's the fastest they have ever done historically. However, they tapered as they went up. So they started at 75, went to 50, tapered down to 25. So now we're kind of at every other meeting, we're going to do a 25 basis point hike. At one point in the meeting, during the questions section, Jerome Powell came out and said, yeah, we're going to skip. And he goes, that's the wrong word to use, is skip. I think that was a Freudian slip. I think they already have planned out right now. They're skipping this meeting that they're going to do rate hikes, and then they're going to do a 25 basis point hike in July. So the next one after that to get us to that terminal rate, we don't know. We are seeing inflation coming down significantly, but core inflation is still at 5.3%. PCE numbers are coming down, but there's still a little bit that's sticky there as well. We are also seeing rents not coming down like we had anticipated. They're coming down a little bit and they're leveling off, but it's not what we had wanted to see. So they still want to see that happening. The housing market still hasn't fully cooled off yet either. So there's a couple of other things that the Fed needs to do to make these things come down. That's why they're still anticipating these rate hikes for the rest of the year. Now, with that said, we are seeing the M2 money supply below inflation. So we are looking at deflationary pressures. And we've got Genevieve coming out tweeting about how the new risk could be deflation since the M2 money supply growth is negative. Inflation will cool quickly. And as we can see in the chart here, the money supply is coming down drastically. So again, that's less money in the market to be sloshing around, and inflation is still high. So we are seeing deflationary pressures. Again, with the PPI we saw this morning, we're at a negative 0.3 month over month inflation when it comes to the producer price index. That is deflation. So they're calling it disinflationary, which is fine for the moment, but when you start looking at that down the road, that becomes deflation. And Elon responding to this, deflation is coming. And so if we've got deflation coming, or at least some indicators pointing to that, that goes back to my thesis of the end of this year, we could be seeing a bigger recession coming. Don't know if it's going to be big, little, whatever it's going to be. But when everybody keeps asking, what are the things that I see that I think are going to cause us to have this major pullback? It's just this. You look historically, again, when the Fed pauses, we see a bit of a run. Now, this time here, it's kind of a bit weird because it's not like a true pause because the Fed is pausing, but also anticipating going up on rates every other meeting or whatever they're planning on doing. Either way, it seems like it's not a true pause. So it's kind of like they're pausing, but they also wanted to pause but prevent a massive rally from coming in the market. So it seems like that's what they're really trying to prevent. So that's what they've got going on right now. But then when the Fed pivots, that's when we end up seeing the market bottom. Now, it's not that the Fed pivoting is causing that pullback in the market. It's because something else in the economy has caused the Fed to need to pivot to reverse course. And we were already on that downward trend when it comes to the market. That could be the deflationary pressures that we are starting to see with the M2 money supply. We start seeing these things coming end of the year. Money supply is down. They are anticipating the unemployment rate getting up over 4%. So you have more people that are unemployed. That's less people working, less money being spent because there's less people being able to work. That whole entire trend, again, is that domino effect that we've been talking about. People lose their jobs, they can't afford their mortgages. We see the housing market start to pull back. We see people who are paying rent not being able to pay rent. Then their landlords aren't able to pay their mortgages. So those end up going under foreclosure. We end up seeing even more of the housing market pulling back. Those two pieces still need to play out in this entire scenario to bring the economy where the Fed wants it to be. So this is really the direction that we're going. And it's not like the Fed's trying to induce a recession, but there's a lot of cleaning out that still needs to be done in the Fed's eyes. So that's the direction that we are going. And the Fed did not do anything today to tell us otherwise. As a matter of fact, they specifically said not one member of the Fed board came out and said that they were anticipating a reversal of the rates this year. Rates are not coming down this year unless there's some sort of catastrophic drop in everything. Again, we are seeing year over year inflation down to 4%, which is great, but we still need to be paying attention to the month over month inflation, and we want to make sure that those numbers stay in line and stay steady. We're at that 0.1%. It's a good place to be. We want to make sure we're staying there. We start seeing things going into the negative, that goes to deflation. A lot of us who are, consumers are happy. Hey, finally, prices are coming down. We can afford stuff again. But when you start looking at it from a macro environment standpoint, and you start looking at now businesses won't have as much money coming in, businesses don't have that money coming in, that means that they can't pay the wages. So we are still seeing a strong wage growth going on, but it's staying in line with the inflation, which is around the 2% that they want to see. So you want to see both. You want to see the inflation at 2%, wage growth around the same place. That's going to be moving the economy forward. We are still not in a settled place yet. So while we are all excited about the market rallying, we're all excited about Tesla being where it's at, we still need to take a step back and realize that we are not settled and in a good place yet where the economy is back to a solid, steady growth place yet. We are still kind of shrinking in the moment. So they are anticipating a GDP lower than normal this year of 1% and 1.1% next year. This is going to be a long, drawn out process of pain. So I think, again, it'll be 6 to 12 months that we're going to see. So I think sometime in the next 6 to 12 months, we're going to see that pullback happen. We'll end up seeing the actual bottom of the market, wherever that's going to be, is going to happen most likely in the next 6 to 12 months. Then, as we come out of this, it's going to be a slow growth. So you're going to see, obviously, the biggest players are going to do the best coming out of this, but it's going to be a lot of uncertainty. It's going to be about 6 months probably before we realize that we've actually hit the bottom. But we're going to grow out of it slow. The Fed is still anticipating a 4.7% interest rate at the end of 2024 and a 3.5% at the end of 2025. Still pretty high interest rates. So we're looking at, the Fed wanting an interest rate to be between 2 and 3%. We won't see that for at least 3 years. It's going to take some time. So again, unless we see some massive deflationary pressures come in that force the Fed to pivot a lot sooner, we can anticipate it being a long, drawn-out process for all of this. Now, with that said, I still think Tesla is going to do extremely well. My thesis on their price targets have not changed at all. I still think we're going to see potentially 247 at the end of this year. But as I mentioned the other day, it's the closer we get to the end of the year, the harder it is to predict near-term movements in the stock price. But my long-term thesis is staying the same. I still think 2025 is going to be that big year for Tesla because I think that's the big year that the entire economy can finally breathe a sigh of relief. 2023 still going to be uncertain. 2024 election year, we're kind of, reeling from what we could be seeing as a bottom of the market at the beginning of the year, still kind of shaking things off and maybe coming out of the fog. 2025, we can finally see the light again. People start get the excitement back. We start to see a real true bull market forming again. That to me is how the timeline is going to be playing out over the next 2 years. So we'll see how that actually all goes. But in the meantime, I am going to be changing my investing strategy for Tesla just slightly. Seeing as we are where we're at right now, I've been putting $20 a day into Tesla. Because of what the Fed said today, I am now reiterating my stance about the fact that we are going to be seeing a pullback at the end of the year. I'm going to be having Peggy on here on Monday morning. So we are going to be discussing a lot of that as well. But because of that, I'm going to be dropping my daily allotment down to $15 a day. I still don't want to miss out, and I still think Tesla is going to be doing extremely well. But I do think we're going to see that pullback, and I want to have more cash on the sidelines ready to add when we get to that point. So dropping it to $15 a day, I'm going to be adding all the extra cash every single week to my cash stock pile. Now, I'm also going to be looking at TSLL and TSLY. Those two there, I'm going to be adding to. TSLY, I currently add $3 a day into as well. So I'm adding into TSLY daily because I like the dividends that they pay out. TSLL, I got in nicely at $9.55 in my IRA. When we see this pullback, that's going to be one of the positions that I'm going to be adding to. So I'm going to be adding to that position. I'm going to actually add some into my main portfolio as well. When we get to that point, I will let you guys know. As far as I can see right now, none of my accounts and any of my platforms allow me to buy into that fractionally or on a recurring basis. So I just have to kind of time that one a little bit better. But either way, all three of those are going to be big plays for me when we see this pullback, and I want to have plenty of cash ready. So I'm doing that right now. Once we get closer to that time frame where we're going to start adding in, I will keep you guys posted on that, just to let you know what I am doing with my portfolio. Because again, those are the three big pieces I want for Tesla to be able to move forward. And TSLY is going to be paying out dividends on Tesla, which is pretty darn awesome. So this month alone, it was 59%, I believe it was, that I got paid out. That payout comes tomorrow. So we'll let you guys know what that payout actually was. But man, I mean, it's significant money that I'm getting back in those returns just from that. Now that has gone up significantly. I have a cost basis on that around $14, and it's just over 16 right now. But if it's going to be pulling back, I'll be able to add more to that also. So again, that's my current strategy for all of my stocks for Tesla right now. I'm looking at a lot of other positions. I thinned out a little bit more SoFi today. I love SoFi long term. I love the app. I love the platform. But again, I think this pullback is coming, and I want to have cash available to be able to buy in at a lower price. So that's just my strategy for you guys. You guys can let me know in the comments below what your strategies are and what your thought process is behind what Jerome Powell had said today. And we can discuss that in the comments because everybody has a different view on this. Whether you agree with Jerome Powell or not, this is what the Fed is doing. So we really need to take into account what the Fed is actually doing versus what we think they should be doing, because guess what? What we think they should be doing, they may not be doing. So we really have to follow along what they're truly doing and how the economy is going to move with it and how the market is going to trade along with that as well. So that's all I've got for you guys today. Unfortunately, yes, Tesla did break the streak, but hey, 13 days in a row, pretty darn awesome to start the month. And again, we weren't even really down all that far, only down about 0.75% on the day. Not huge. We'll see how the week is going to finish out. Probably won't have a video tomorrow night since I get my son, but I will be on for a live stream on Friday night. Hope you guys have a great one. Thank you for all of your support. See you later.